Welcome to Sectors Up Close. I'm Thomas Warner. Today we're looking ahead to what could be a brutal year for US office owners with Xander Snyder, Senior Commercial Real Estate Economist at First American. Nearly 5 years on from the start of the COVID-19 pandemic, a much-feared apocalypse in commercial real estate is yet to materialize. Demand for data centers and warehouse space has never been higher, and the effect of low office attendance has been masked behind long-term lease agreements. But could 2025 be the year that something finally gives? Well, Xander Snyder from First American joins us now. A very warm welcome to you, Xander. Before we look ahead to 2025, I would just like to get your take on just how low office occupancy rates are in the US at the moment, 5 years on from the start of the pandemic.
Thanks, Thomas, for having me. Yeah, well, it depends on which data vendor you use, but physical office vacancy rates are between about 30 and 50%. So people are still going into the office a lot less than they were. The First American economics team, we've created this metric called U-shadow vacancy, or underutilized shadow vacancy rates. And it mainly looks at the major office metros in the US. But the idea is physical vacancy can be driven by, fewer people going in and out of a building. It can also be driven by higher leased vacancy rates. So the U-shadow vacancy rate is a measure of what space is leased but being underutilized. So it's a bit of a forward-looking metric in that sense. What space might not be needed in the future by current tenants? And what you can see is that in most major metros where underutilization has been high, vacancy rates have subsequently increased. There are a few metros where there's an exception to that, but that's generally been the trend over the last several years.
So it certainly sounds like you've got confidence in it. And there was a lot of hope at the beginning of the pandemic, Xander, wasn't there? That a lot of this potentially disused office space could end up being used to help solve the housing shortage. How much sign of that have you seen?
Some. I think what we're seeing is that the number of office conversions, and it's not just into apartments, it could be other types of asset classes like life science, but they're certainly growing. There's much more of them going on now than there were pre-pandemic. But if you look at the amount of office space being converted relative to total stock, or if you look at the number of apartment units being created from office space relative to total stock, it's still quite small. It's too small to really fundamentally change the supply and demand dynamics of either office or apartment. But that could change in the future if zoning changes to allow more of them to occur. They're expensive and hard to do is the nutshell on that one.
All clear. Thank you very much. Well, let's turn to 2025. It seems from your notes that you're predicting a world of pain. What's your thesis?
Yeah, I think that there will certainly continue to be challenges in the office space, and part of the distinction between office and other commercial real estate asset classes is worth making, because I think for the vast majority of commercial real estate asset classes, there's been a cyclical adjustment, which is to say that prices have adjusted. It kind of feels like the end of a cycle. It feels like we're entering a new cycle. With office space, I think there's a qualitatively different essence to the adjustment. I think it's a structural adjustment, which is to say, I think the rise of remote work technologies has fundamentally shifted the amount of space that we need and demand to do office sorts of stuff. And as a result of that, I think the adjustment phase is going to be much longer for office properties, and it's going to be because we just don't need as much of that space as we did beforehand.
And Xander, we are seeing a lot of concern in the market that the new Trump presidency could mean higher inflation and therefore higher interest rates all through next year. So presumably that's terrible news for anybody that's looking to get a new mortgage next year.
Lots of people are concerned about interest rates, and they have been ever since they started really going up sharply in mid-2022. I think as it comes to the Trump presidency, we kind of just need to wait and see. We don't exactly know what policies are going to be implemented yet. And depending on what the details of those policies are, that could really change the impact that it might have on inflation or interest rates. What I will say is that over the course of the last 2.5 years, as interest rates have moved up, the market, and by this I mean if you look at interest rate expectations, there's a group that monitors this, they've kind of repeatedly not been on the mark. So if you're an operator in the market and you think that your thesis A is going to happen, have some humility and have plans for alternative outcomes that might happen. Because a year ago in December, the market was expecting 6 to 7 rate cuts. This year didn't happen. So that's my take on interest rates. Have a plan B.
And just one final question for you, Xander. Obviously, we are seeing this divergence between many forms of commercial real estate and office space. So do you think there are emerging signs that we're going to be seeing investment opportunities that actually avoid that sort of poisonous office sector?
I think yes, but I'll say that I don't think the challenges that characterize the office sector are true of every single office building. And the thing that I like to tell people is you can still make a 30% occupied office building work, a deal for a 30% occupied office building, if you buy it cheaply enough. So it really depends on how cheaply you can get the property and what the dynamics in the immediate area of the office property are. I think you already see there are signs of big investors stepping back into the market for both some office properties, but certainly other types of asset classes in commercial real estate. So yes, I think there's more investor activity coming in the new year.
Xander Snyder from First American, thank you very much indeed for your time today. And that is your roundup of the commercial real estate sector. I'm Thomas Warner, and this is Reuters.